everybody, and welcome. Tom Daly here from the Academy of Financial Trading. We are about to begin your fourth lesson as part of your foundation trading program. This evening's lesson, it's one of our own personal favorites, whereby we're going to start looking at charts. We're going to be trying to find ways that we can understand what is happening and where other opportunities might actually be presenting themselves. We're also going to discuss areas where people are, highly indecisive, where they don't know what might happen next, and where we can position ourselves to maybe have multiple potential trades going out into the marketplace. So this evening's lesson is going to be quite exciting. Hopefully it's going to be very enjoyable. We will begin this, as every other lesson, with what you can see on the screen in front of you now, which is our risk warning. Obviously, we aim to help you to understand what risk is and how best to manage this risk. When we speak about technical analysis, we try to point out that you can use it as a way of finding opportunities in the market. You can use it to find ways to get out of trades in the market and of managing your risk. In this webinar, there's probably a pretty even split in terms of who has traded before and who is totally new to trading. So maybe let's start out by speaking to those who have traded before, those who have a little bit of experience. Have you ever been in a trade, in a position, in a particular stock, and you found your way into it for whatever reason? You watched yourself gather some gain, only to then watch them disappear when the stock price fell or when the price of the market which you were looking at actually fell. Maybe you didn't know exactly how to get out of that position. Has that ever happened to anyone on this webinar? I can see that Bob and Mark and Paul and Aisha and Emma and Cornelius and Robin. Absolutely, it's a story that for many who have ever traded, it happens far too often. And throughout my own career, I've watched it happen to many, many different people. You might find a trade, you might get into a position, it might make you some money, and then it's almost as if you remembered the good times. You remembered when that position was making you those profits. You sit and you hope for it to go back up. And you see, that's incredibly dangerous. But if we're using technical analysis and if we're just measuring what the market is doing, well then, if you are following a position, if you're adjusting your stop loss, and if you're protecting your profits into the marketplace, if it falls down, you've got an objective way out. So even if you don't like the type of approach which we like is best for looking at entries, at least pay attention for this section when we're talking about exits. So let's talk about this a little bit further. We feel that this can be a totally independent heading, separate from absolutely everything else. And the reason why we feel that is because it makes profits for us. It's that simple. We don't like fundamental analysis, and that only on-demand class, that lesson number 3, which is made available within your members login area over the weekend, where we dealt with fundamental analysis in totality, you will see if you did listen to it, and I would suggest you take the time to go back and go through it at some point, but you will see why we don't believe that fundamental analysis is important in trading. We believe that because the concept, the difference of what is good and what is bad is a very difficult question to answer. We don't like fundamental analysis because of the fact that we don't have a crystal ball. We don't have a DeLorean to travel back or forwards in time. And we also say that a hybrid, a mixture between two systems, that can also be quite dangerous. A hybrid is a mixture of two different types of analysis. In natural sciences, it can be quite dangerous, and in financial trading, it can be quite dangerous. So what we're talking about here is the type of trading where you look at charts a little bit, where you look at newspapers a little bit, and basically by the end of it all you have no real idea what you are doing. That's what a hybrid is. It's a combination of a lot of different things. And we know that just about every educator out there, they tend to like hybrids. The reason why is because it means that educator can never be wrong. What we're going to do is we're going to just focus on quantifiable objects, on what exactly we can measure. So let's define technical analysis. What it is that it is the study of price action. What we are trying to do is we're trying to measure what has happened as a way of gauging what is likely to happen. So we're measuring the past in order to prepare ourselves for the future. And it's based on the idea that history repeats itself. What we're going to do is we're going to use charts as our interpretive devices. More importantly, or more specifically, we're going to use Japanese candlesticks. And when we look at technical analysis, guys, unfortunately, we at the Academy of Financial Trading, we did not invent technical analysis. Fortunately for us, from a competitor perspective, neither did any person who is currently living on this planet. You see, we've used technical analysis for as long as we've engaged with one another from a commercial perspective. Let's try to explain this a little bit more. Let's imagine when human beings, when they started trading agricultural products for whether it was pieces of metal or for machinery or something along those lines, they would have remembered what price they would have achieved last season, last year, over the last decade. And it is that remembering of the price action which you could call technical analysis. What we try to do is we try to measure it much more efficiently in real time. So what is the basis of technical analysis? Who can help us out with this? Why do you think it might be a good way of operating? Or what's the premise upon which it's built? Why would measuring price be a good idea when we're looking at the financial markets? What do we think? Absolutely. Paul, you're saying human or market behavior. Matthew, you're talking about cycles. Orlando, you're saying that history always repeats itself. John, you're saying it's an indication of what might happen. Historical data, says Chris. These are all absolutely beautiful explanations. And there is maybe one further one, and it's something that very few of us perhaps like to admit. We, as human beings, we can be incredibly repetitive. All you've got to do is ask someone close to you, somebody who loves you, somebody who cares about you, somebody who is not afraid to tell you the truth. Do you have any bad habits which you repeat? And I'm sure that there are some people in your life who are happy to list every bad habit that you might repeat. But we all have them. We all have habits. We all have characteristics, and they are very hard to change. So why is this important? You see, when you look at financial trading, people make and lose money every single day. So let's just take a moment to think about this from a conceptual sense. People make and lose money every single day. And when we make or lose money, we become somewhat more predictable. Let's speak about this a little bit. Let's imagine a bit of a scenario, okay? Let's imagine a car scenario, a driving scenario for all of us as automobile enthusiasts on this evening's webinar. So let's imagine that you had just published a vehicle of your dreams, a car that you had been yearning for and working for months or years. You'd been waiting for the opportunity, if it ever presented itself, where you might be able to purchase one. You get into that vehicle for the first time after you have bought it. You start the engine and you drive it out of the garage, out of the forecourt. You drive it home. You're just parking the vehicle of your dreams in your driveway or in your apartment block or in your garage or wherever that may be. And straight away, you hear the most horrific, the most terrible of noises, which is a metal object ripping into the side panels of your car. Not one wing, not one door, not one panel, but just the whole side of the car. You get out, it's not just the paintwork, it's gone beyond the paint into the metal of the car. Guys, how would you feel in that exact instant? You're standing there, you're looking at the car, you can see the extent of the damage which is being done, and you were just about to show your loved ones, your friends, your family, this beautiful vehicle that you had been working towards for so long. Absolutely, Michael. Absolutely terrible is a very good way of explaining it. That is very sick. Absolutely horrible, says Laurie. Gruesome, says Natalie. There are a lot of words coming in that I would definitely say, I would definitely feel, were it not for the lack of an age limit on this webinar. You would be upset, you would be heartbroken, you would be frustrated, you would be devastated, you would be in shock, Dara. Absolutely. And what is that feeling in your stomach? It's that feeling of loss, that feeling of shame almost, that feeling of embarrassment, that feeling of opportunity cost, that feeling of disappointment, all of these human emotions, that churning feeling. And let's think about this a little more. And let's imagine that that exact same instant had happened you 1 year later with that then vehicle that you most desired. And at that exact same instant, 1 year later, if we'd asked you the same question, would your feelings be any different? What do you think? Just a Y for yes or an N for no. At the exact same snapshot, with the exact same desires for the exact same object, would you have felt similarly? Of course you would feel the exact same. And why is that? It's because when we make or lose money, whether it's today or yesterday or last month or last year or next year, we become emotional, we become repetitive. We are human, we feel loss. We remember these emotional states. And what technical analysis tries to do is to try to find when people have that feeling and find when people have that understanding of success. Okay? So the issue here is that technical analysis can provide us with a much clearer cut approach. And Syed, you're saying, well, then we won't repeat it, won't we? Well, what it does is that it provides us with that greater level of objectivity. So that's what we need to use when we are trading, when people make money and when people lose money. Now, the fundamental analyst, they try to predict a fair market value. They look at the object, they look at a balance sheet, they look at a price to earning ratio, they look at a cost of distribution, they look at unit sales in a particular region, and then they finish up and they say that everybody else in the market is wrong and that object, is either undervalued or overvalued. Everybody else has got it wrong. They value it differently. That ignores the idea that the markets are efficient, that they factor in change in real time. The technical analyst, they just look at the object and try to measure what it is doing and try to find an opportunity based upon that. So it gives us much greater objectivity. It's much easier for those who are new to trading to perform. So what we're going to try to do is a process which we call See, Accept and Trade, SAT. We're going to look at what's on the chart, we're going to see what exactly it is doing, and we're then going to trade providing we have confirmation. And confirmation is going to be like a positive signal telling us that a trade might exist. Let's look at this further. What we must be conscious of is that we're at the starting point of our journey. We're learning what all of these individual factors are. And over and above that, we must combine them together. So this evening is the starting point of technical analysis, the very starting point. It'll take at least the next 3, if not the next 4 classes to go through technical analysis entirely. Okay? The main tools which we will be using will be Japanese candlesticks, and we're going to explore them in just a few moments. And then we're going to look at indicators. And there are a huge amount of indicators. There are a huge amount of people who think that they can trade using these indicators. Those who can trade using them, they might be able to make a profit. Those who can't trade using them, they mightn't. They might consistently lose. But what we're going to look at is how to identify those people who might lose. So let's put everything in context. Most people focus upon a trading edge, on the holy grail of trading, on understanding something which nobody else understands. But in just every other area of business, every other area of sport, every other area of any other endeavor which we might look to succeed in, it's important to understand your opponent. So what we focus on exclusively is that. How to identify when people might behave predictably. How to identify these retail traders. And this word, or these two words, retail traders, this is something which you'll hear us speak about quite often over the course of the remainder of this webinar program, over the next 3 weeks. Retail traders are typically people who just enter the market based on some very subjective reason. They're entering into the market for their own, out of their own opinion, out of their own maybe backward analysis to a degree. They mightn't have received an education. They mightn't understand exactly how and why the markets work. They are the people who lose more often than not. So these are the traders who we will be targeting. So remember that word, retail traders. You'll always hear us speak, or you'll often hear us speak, that our methods are counter retail trading. So we trade counter, we trade against the normal retail trader. So that's what we will be concentrating on as we progress a little further. So let's speak about what these candlesticks represent in order to show whether buyers or sellers are winning a battle. Let's not overcomplicate things, because I suppose some of the names which we will use in order to describe some specific candlesticks, they might be considered to be quite unusual. Too often people get tied up or wrapped up into what the names are rather than the potential action which they represent. We will not overcomplicate anything. In light of everything which we will be doing, we just need to focus on one of two things. Who is winning a particular battle and who is losing a particular battle. That is all we need to worry about. Nothing more and nothing less. So there are 4 crucial pieces of information which every single candlestick tells us. Who can help us out with what those 4 pieces of information actually provide us with? What are the 4 pieces of information that every single candlestick gives us? What are they? Let me have a look. Who's typing in the right answers? Quite a few people, thankfully. Great stuff. People have been paying attention up until this point. The 4 key pieces of information are that they provide us with an open price, they provide us with a high price, they provide us with a low price, and finally they provide us with a close, or with a low price, excuse me. So we got an open, a high, a low, and a close. And on the screen in front of us now we can see a green candlestick. Now we can see a red candlestick. The green candlestick is what we would call, I guess, the optimistic candle, where the price has risen throughout the day, where the price has closed at a higher level from which it opened. It's an optimistic candlestick. We can see the open is the bottom of the body, the high is the top end of the wick, the low is the low end of the wick, and the close is the top end of the body. We can see the exact opposite applies for the red candlestick. Where the open is at the top of the body, we know that the price is decreasing throughout the day. The high is the same, it's the top of the wick. The low is the same, it's the bottom of the wick. The close is the bottom of the candlestick. So yes, we see this green candlestick as an optimistic one where the price has been rising, and we see the red candlestick as a pessimistic one where the price has been falling. So reasonably straightforward, but it does give us quite a lot of very useful information. We can see on this gold candlestick chart, we can see where the price has been obviously falling, where there is a red candlestick, and we can see where the price has obviously been rising, where there is a green candlestick. And we can see in the time frame given in this example, from December all the way through to present day, we can see, I guess in the grand scheme of things, that the price has been increasing over the past month or so. Would we all agree with that? Could we all agree that over the past month or so, the price of gold has been increasing ever so slightly? Sideways to a degree, maybe right up until the end of the year, but ever since January, ever since the start of the new year, we've seen a reasonably good rate of growth. So what this chart tells us now is whether or not the price will rise or the price will fall. Typically, it's not enough to just look at it over such a short period of time. You will see on the top left-hand corner where we have the symbol for gold, which is XAU USD. That's AU, which is the chemical symbol for gold, USD, which is US dollars, and X at the start, which simply stands for the cross of gold in US dollars. And we can also see H4. That H4, it simply means that each candlestick is worth 4 hours. H4, 4 hours. Every single candlestick is worth 4 hours of trading. But when we look at any chart, the very first thing which we typically do is we zoom right out to see what exactly this market has been doing over a longer time period. So we are now in a daily candlestick chart where every candlestick is worth 1 day. And we're going back the last, almost 4 months now. So we can see over the past 4 months, it's almost as if the scenario has been to the opposite side of the spectrum. We can see that it has been gradually falling over the past 4 months. And again, it's only since the start of the year where we have a reasonable recovery. But that recovery, it's still nowhere near the upper end which the price of gold was at all the way back in just October of last year. So when we zoom out a little bit, we just get a little bit of perspective. Instead of jumping into a chart based upon a decision that you think everything is going to go up because the most recent action is telling us that. What we're going to be looking at, not only throughout this evening's class, but over the next 3 to 4, possibly even 5 classes in particular, are technical analysis, which will allow us to consider things like an area where there has been a breach. We can see at several points in time, this area, they tried to get through it and they were unable to. Only very recently there was a breach above it. So we might look for opportunities on such a break. We might go long, L for long, on a breach above a particular area. And just like a breach above a particular area, we might go short, S for short, if there is a breach below a particular area. So these are the types of things which we will be looking at as we progress a little further into this type of technical analysis. So let's go and look at this a little further. What we are speaking about is Japanese candlesticks. They show the previous price action. Because they are just showing the past, they are absolutely indisputable. Absolutely nobody can argue with the information which they are providing us with. They do not lie to us. They're not trying to predict anything. What we now need to look at are some patterns, are some more patterns. Can anybody on the webinar name some of the patterns which you might see with Japanese candlesticks in particular? Who has used these kind of charts before? Anybody got it? Who's got it? See, Dibia, you've got it. Frederick, you've got it. Absolutely. What else have we got? Jeff. Okay, you're only starting out. That's absolutely fine. What else have we got? Adrian, bang on the money, as is Vince. Great stuff. What we're going to be going through now, guys, are specific Japanese candlesticks. As I've said already, do not worry about the specific names which are attached to them. They have to be called something. Don't worry about the names. We're more concerned about what they stand for. The very first one which we will be looking at is called a doji. And all that this represents is absolute indecision. You have an open price and a close price at the exact same level. The market opened at 100 and it closed at 100. At some point it went up to a high point. At some point it went down to a low point. But can we understand that we have got absolute indecision? If the open price and the close price are at approximately the same level, you've got absolute indecision. And what that can then present to you is opportunity. Because what you can decide is when the market breaks one way or the other, that you might be able to find opportunities as a result of that. So what you say is that this candlestick, you might be better off calling it a spotlight. It's telling you to pay attention. Because if it goes above the high point of that day, or if it goes below the low point of that day, it might be providing you with that spotlight to perhaps place an order and enter the market because something outside of the norm is actually occurring. And by no means is this giving us enough to actually enter and risk our cash, but what it is saying is that there is one piece of confirmation if the market does that. So we just want to quickly compare this doji to a different type of candlestick. Can you all see the difference between a candlestick which I'm circling now, which is showing absolute indecision, and then we've got the green candlestick, which I'll call number 1, which is showing very decisive action, and we've got the red candlestick, which is number 2, also showing very decisive action. Okay, great stuff. We're beginning to get it. So we can see in candlestick number 1, we know that it is an optimistic candlestick where the price has increased throughout the day. So in this battle between bulls and bears, in this battle between buyers and sellers, in this green candlestick, which I've labeled as number 1, who has won that particular battle? Who do you think has won? Well done, Andy and Joachim and Laura and everybody else, Jason and Rada, everybody who's typing in bulls or buyers. Absolutely, they have won the battle. And then the opposite side, I would hope you would agree, would have won the battle in point number 2, where the price has decreased throughout the day. The bears have obviously won, the sellers have obviously won. But if we go back to our doji, I'll just label it as D just to make it completely separate. Can we all agree that there is no clear winner for our doji? Neither the bulls nor the bears have won that particular war. Neither the bulls nor the bears have won that particular battle. Can we all agree with that? Okay, brilliant stuff. We're getting the purpose of it. What we can do now is look at it on a chart. We can see that thick black oval shape which has circled that long green candlestick. There is an obvious winner in that battle. The bulls have obviously won. The price in gold in this historical chart has moved from about 11.94 all the way up to around about that 12.16 level. The bulls have won. And then if we look at the opposite scenario where the bears have won, we can see where the price has decreased from that 1200 level all the way down to that 1185-ish level. We can see that it's obvious to our naked eye that the bears have won, in that second scenario. But let's have a look, and right at the top of the chart, back from the middle part of May of last year, Can we all see that doji where there was neither a winner nor a loser? We can all see that second one where there was neither a winner nor a loser. That third and fourth one where there was neither a winner nor a loser. That fifth one, that sixth one, that seventh one where there was neither a winner or a loser. Can we all now understand what indecision means? There is not a clear winner to either side of the battle. Can we all understand that? There was a stalemate on that particular day. But what we are looking for is for somebody to break that stalemate. Somebody to come along, whether it's the following candlestick or the one after, and show us a clear winner. So what we say is that these doji represent indecision. And what we do when we see them is we wait for a move to occur which will show us absolute decision. Okay, so that's candlestick number 1 out of the way. That's the doji. We're going to come back to it time and time again, but just by recognizing it. Again, don't worry about the name. Just by recognizing it, by having no body, by the open and the close being in approximately the same level, you now know that that means indecision. There is no clear winner. So we have a doji. The next easiest one to continue on with is a long-legged doji. It's the exact same as what we have just covered, the only difference being that it is a little bit more exaggerated. The open and the close is still at the approximate same level. The high point might be quite a distance away, the low point might be quite a distance away, but still the market opens and closes at the same approximate level. It doesn't have to be the same exact level, the same approximate level. And again, when we compare it to a market which has a very obvious winner and a very obvious loser, we can see the difference which exists. So what I'll do is I'll just remove my drawings and let's move on and have a look at this long-legged doji on a chart. I've zoomed out a little bit, I guess, in this chart. This is a Euro JPY chart, so the euro currency versus the Japanese yen. But there is one good example. It's almost right in the middle of the screen. There it is there, where we can see a little bit of excessive indecision. We have a longer upper portion, we have even a longer still lower portion, but we have that long-legged doji showing us indecision. That indecision is also shown to us by the market trading sideways for a short period of time. But can we see what happens once that indecision has been resolved? And it has been resolved at that exact candlestick there. And what it does do is it moves then strongly in a given direction. So that's why we don't like to get involved when there is indecision. That's why we like to wait for decision. And that's something that we're going to be returning to time and time again. Let's look at it in another example. This one a little bit more obvious because we've zoomed in quite a bit. This is the S&P 500. It's going back to the earlier part of last year. But again, we can see the same thing. The market moved up, it moved slightly down. There was a huge area of indecision where the market was not sure what it was going to do. We can even say the following candlestick, even though it has a small red body, that could still be classified as being indecisive. But once the decision was made by the bulls that they were the ones that had the upper hand, the market took off to the upper side. It took off towards the top end of the range. So that's two instances out of the way. They both show indecision. And I'll let you into a little bit of a secret before we continue on. Most of the patterns which we will be looking at, they will tend to show us this indecision. Okay? Or they will tend to show us something which might be classified as absolute decision. The next one we're going to look at is this gravestone doji. This, instead of being a 50-50 chance as to whether it's going to rise or fall, what it does do is it provides us with a little bit of direction. Just a little bit of direction, which will favor one direction over another. The explanation of what it is in itself is that we have an open point, we have a high point as always, we have a close point as always, and the low point is at that same approximate level as both the open and the close. So there was a push up throughout the day, and then the market fell back down, and it landed at the end of the day at that same level as the open point. Although it represents indecision still, we say that if this type of signal occurs in an uptrending market, it can be a signal to say that a sell-off is about to occur. If it occurs in a downtrending market, it can be a signal that a rally is about to occur. Now that might sound a little bit contradictory. So let's have a look at it as a bearish signal when the market is trending upwards and see exactly what we mean. So this is just a range of candlesticks which we have drawn out. Okay, so let me just get out my pen here so we can go through them and understand exactly what is going on. Okay, so I've got candlestick number 1, number 2, number 3, number 4, and number 5, and even up into number 6. Number 6 being our gravestone doji. And let's use a bit of an analogy here. So the market is moving upwards, slowly, steadily, not straight up. We have a little bit of a down day, that's fine, but the market continues up. So let's imagine that this wasn't actually a market. Let's imagine that you're a mountain climber, okay? And let's imagine on the first candlestick, that's day number 1. You've climbed up, you've made your camp, you stay there for the night, you get rested, good stuff. You get up the following morning, day 2, you go up a little bit more, great stuff. Day number 3 is a bad day for you for whatever reason. But day number 4 appears, you do a little bit more climbing, all is good, you're making your way up along the mountain. Day 5 is a great day, you push even further up the mountain. Now imagine day 6 occurs, and imagine the summit is almost in sight. We'll say the peak of the mountain is up here at X, and on this day you wake up and you're full of energy starting out. You go up to a high point, but then something happens. Maybe the weather hits you, maybe fatigue hits you, whatever the case may be. And what happens is you go all the way back down and you make your camp at the exact same level at which you started out. Do you think when day number 7 arrives that you're going to be full of confidence and optimism to do that journey all over again and then push onwards and upwards up to the peak? Do you think you're going to be full of confidence? Do you think you're going to be full of enthusiasm? Do you think you're going to be full of energy? Or do you think it's more likely for you to shake your head, try to rest your weary bones and head back down the mountain, maybe a little bit unwilling to accept defeat, but nevertheless it is so? And that's what tends to happen. We say it's bearish in an uptrend. Things were going well. The market was trending upwards. Then this gravestone doji appeared, and what happened after that was the market just fell off. The market fell off, weakness took over, and that's exactly what happened. And the reason why it happens is that every seller which is out there, every bear which is standing on the sideline can see this. They can feel the fatigue which is being experienced by the bulls, and they just take advantage of it. They just press the market downwards because they can feel that the bulls who have pushed the market upwards into this high point are saying to themselves that I'm weary, I'm tired, I'm fatigued, I do not have the energy to press it any higher. The bears then go, yes, we feel that this is now going to work out in our favor. We feel that if we start selling at this point, we're going to win. So they start selling and they push the market further down and down and down. Does that make sense, guys? Does that make sense? Because that's what happens. You've got to try to relate the market action back to something which you might be, be au fait with. You might be somewhat it might be understandable to you. But the price action tells us exactly what is happening. And now we can say the exact opposite. We say that if this gravestone doji occurs in a downtrend, we can say that it's bullish for that exact same reason. Because the bears have run out of puff. Okay, so we have our downtrend, we can see our gravestone doji appearing at X, we have a reversal, and off we go. So instead of being 50-50 as to what might happen, we can say that we favor one scenario over another. And these next few examples, they're all almost carbon copies of this, where there is a little bit of favoritism in one direction than another. So we had our gravestone already. This is our dragonfly. Again, don't worry about the name. All we've got to do is know that it does mean indecision, but it's more likely that a reversal is about to take place. So if we see this occur in an uptrend, we know that it's going to be a bearish scenario. The uptrend, the market is pushing onwards, things are going well. It's the same type of mountaineering example if you wish. Okay, so on day number, what have we got? 1, 2, 3, 4. On day number 5 in this instance, we were pushed way down below the starting point of the previous day, back into day number 3 almost, and we dragged our weary bones back to that same point. Again, you have to ask yourself the exact same type of question. If that was the case, if our hard work was pushed back at us, if you like, if every single thing which we have done for the previous 2 days we had to redo in the space of 1 day, how confident would it be that you were going to push further up? You would not be confident in any way, shape or form. It would be more likely that the market would reverse, because again, those bears would sense that opportunity. They would sense that inherent weakness which might be exhibited. The same thing would occur in a downtrend. If the market is setting off and if this dragonfly appears, it simply means that a reversal is more likely to occur. Is it definite that it will occur? Absolutely not. We all know in trading that if anything is certain, it's that nothing is certain. It's never a definite. All it is a potential signal. Let's have a look at it in this Deutsche Bank chart. We can see I think just this one, there's a few of them scattered throughout, to be honest with you. That's one of the more obvious ones. I'll use a better updated chart in just a few moments. Another type of scenario, another type of candlestick which we are looking at is a hammer. Simply because I guess it looks like a bit of a hammer. We've got the handle to the lower end, which is the wick, and then we've got the head of the hammer itself. The hammer can be red or it can be green. It doesn't really matter. The reason why it's called a hammer is because if it occurs in a downtrend, if the market is selling off and you see this hammer appear, it's simply said that it is hammering out the bottom, that it's more likely that this market will then reverse and move upwards because this hammer is hammering out the bottom. If you see this occur in an uptrend, it's also known as a hanging man, because you're leaving investors hanging at the very top of the marketplace before a reversal is likely to happen. So it's the exact same type of scenario. We have our rising market, we have our hanging man, which is leaving investors hanging because the market has run out of puff, and it sells off. Okay, it's the exact same type of scenario. It's showing indecision, but it's showing indecision with a favored direction. When we see this occur in a downtrend, the same type of thing. We have inherent weakness. We see a hammer appear. Perhaps it's going to hammer out the bottom and then move up in the opposite direction. And that indeed is what occurs. As I've shown you in this example here on the right hand side, I'll label it as number 2. It's not just a case where one hammer might appear. It's more often that a couple of them will appear together in order to truly hammer out that bottom before a movement in the opposite direction. Let's have a look at it on a chart and see how it might form in its own natural environment. Where we have this example over here on that far right hand side, where there is not just one, there is two, there is 3 hammers forming, where we have this kind of what we call a sideways pattern. After a movement downwards, we have this sideways pattern where there is a bottom potentially being hammered out. It's potentially showing a reversal in the marketplace. Let's have a look and see it again on this Deutsche Bank chart. What are we looking at here? We can see how on this example it's showing indecision. We would say that this was a hanging man. If it occurred in an uptrend, which it did, it should possibly have signaled a reversal. But this is a good example to show that not everything would work out as you might think it would. We can see that the market then pushed on above in its favor, which is why the risk side of things is so important to be aware of it. This next chart, which we're going to have a look at, let me just get it on screen, GBP USD. And we can see there are quite a few here where we can see, again, it's perfectly hammering out the bottom of a market before a strong move in the opposite direction. And again, over on that right hand side, we can see the same type of thing. We can see a couple of hammers and the market moving up and away from it. So we have that hammer. We also have an inverted hammer, which is also called a shooting star. Again, not to dwell on the names, but again, the same type of scenario raises its head. We have an uptrend, we have the appearance of a shooting star, and we say that it is bearish if it is found in an uptrend. The markets can sell off. If we see it in a downtrend, we can say that it is quite bullish. Where we have the downtrending market, we have that inverted hammer appear, and then it moves in the opposite direction. If we want to look at it on a specific chart, we can see this. If we look from left to right, we can see first off that inverted hammer, a strong move in the opposite direction. We have another inverted hammer at the top, a long sideways pattern which occurred thereafter. You can see all of the indecisive points within, another hammer over here, another doji over here, all in this elongated sideways pattern. We like these sideways patterns. We like them because we don't trade within them. We like them because they afford us to look at the markets, to understand what a retail trader is doing, to accept what that retail trader is doing. It tends to be wrong. It's about exhibiting some patience in order to stand to one side and to wait for an opportunity to present itself. And it's this waiting, it's this patience, it's this understanding of the price action as it is presenting itself, which allows us to take advantage as to what is going on. Okay, so that's one of the reasons why we like them. We like them because we know people who trade it within these sideways patterns. More often than not, they are failing. We prefer standing to one side, waiting for resolution, because that's what will give you a much greater yield, a much greater yield. Okay, what else have we got? Okay, let's have a look. So we have all of these different types of candlesticks, and they are massively important to, I guess, be able to recognize them, to see them for what they are, to recognize them as spotlights on a market, and not to worry too much about the name. It's about training your eye to spot them when they appear. And while everything which we've just looked at is massively important, these next ones are our favorite types of candlesticks. They are powerful, they are strong, they are clear for you to see. So let's speak about these. We have a left-hand side, we have a right-hand side. On the left-hand side, over the course of 1, 2, 3, 4, 5, 6 days, we can see that the bears managed to push the market downwards. But over the course of one day, the bulls came out and they absolutely annihilated the bears. They brought the market up higher than what it had been 7 days ago. The bulls gained a huge amount of territory. Can everybody see that? They burst through the defenses of the bears. So we say straight away that the bulls must have won that battle because they annihilated the bears. On the right hand side, we also have 1, 2, 3, 4, 5 days, but in this instance, on the 6th day, the bulls went so much further than just beating them. If we saw the level from where they came from, and if we see how far above that level the bulls managed to push the market, we can see that it wasn't just a win, was it? It was an absolute annihilation, and it shows you the absolute strength which appeared in that market. When you're looking at both of these examples, would you say that the left or the right is more bullish? And don't second guess it, just see it, just accept it, and then potentially trade it. Do you think the left or the right is more bullish? Which one travelled greater distance? Who has more power? Who scored more goals? Who gained more points? It's got to be the right, hasn't it? So we have a signal. If we see it, we say that it's a piece of confirmation. It's certainly more bullish. So let's check it out on a chart. And on these charts, we're going to ask you to find them. Work the chart from the very bottom left-hand corner to the right. Can you see where the bullish engulfing pattern is? There are several of them, but on this chart, one of the largest of them is down there on that bottom left-hand side. And it shows us the strength which is gathering, and we can see how much it took off after that point in time. If you had been looking at this market way back in the mid area of 2012, going back in time a little bit now, and if you saw this candlestick appear, it would have been a signal to enter. And if you then took it as that valid signal and you saw more and more of these bullish engulfing patterns appear, can you see the kind of gain which is liable to be made? There's massive, massive gains to be made if you're able to analyze the market correctly. Let's have a look at this US dollar Swiss franc chart. Can we all identify the bullish engulfing pattern from last October? We'll circle it in blue to make it as obvious as possible. We can see that we have a number of days where the market moved down, then moved slightly up, but there was never really any great shapes about it. It wasn't showing any massive sign of direction one way or the other really. It was a lot of sideways to downward movement. But then we have that bullish engulfing candlestick which occurred, and we saw the gain which has been made from that point onwards. It was a clear signal that the bulls were now in control of the market. The bulls were in control of the market, and it was indeed going to continue upwards in that trajectory, in that market rising, in the US dollar working with those people who had bought at that 0.95, 0.94 level. So we have that bullish engulfing pattern. And like everything in trading, where we have a bullish side, there is always a bearish side. So let's have a look at these two scenarios again. Okay, so like the last example, we have a left and we have a right. And what we do know, what we can accept, is these bearish scenarios tend to be more violent than the bullish scenarios. If you want to know why that is, it's simply because people tend to panic much more when a market is selling off. There is a saying in financial trading that a market always takes the stairs up or the steps up, and it always takes the elevator down. Because people panic in real time. You've never heard of a market panicking upwards, have you? You've never heard of people jumping aboard a market as it's moving upwards out of sheer panic, and the market moving upwards and flying up day after day after day. We never ever hear that. We only ever hear about things like Black Monday or crashes in the market, or anything like that, because of the panic which exists when a market works against a buyer. But we have these scenarios where there are clear indications that there is inherent weakness in a market. It's best viewed on a chart. We have a number of examples on this gold chart. But can we all maybe see, it's not circled yet, can we all see the most obvious example on this chart? This is an historical example, but it's an historical example for a reason on this gold chart. Can we all see a very, very large, very, very clear bearish engulfing pattern. If you can type in an approximate date or even an approximate price where it started out at, and we'll understand exactly where we're coming from. Mike, absolutely fantastic. Well done. I haven't it circled yet. No, I circled late December 2011. I haven't the one we're talking about, or the specific one I'm talking about, circled just yet. Let me have a look. Okay. What about this one right over here? I'll double circle it just so there's no confusion. So we had, what was it, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, maybe 20 days of sideways to slightly upwards trading. 20 days where the market tried to, if not go sideways, then certainly push itself higher. And over the course of one day, which was, I'd say maybe the very first day of March in 2012, we have this massive bearish engulfing candle, which engulfed every single bit of work that was done by the bulls over the previous 20 days or more. And what happened since that point? If anybody is in any way familiar with the gold market, let's have a look and see exactly what has happened. Back then it was trading right up at that $1,700 to $1,800 level. Anybody who's in any way familiar with gold will know that it has since fallen. It says below 1,200. It's actually, I think, below 1,100 is it at the moment. It's right about the 1,100 mark. Thereabouts. A couple of dollars either side of 1,100 at the moment. And you could have seen this happen in real time back in 2012. To see an example like that in real time. And we can see that same type of panic which exists. You can see the obvious bearish engulfing patterns. This is a more recent gold chart just from the early part of last year, almost a year ago. But from the early, and you can see that pattern downwards, that elevator shaft down and down and down, with that panic hitting time and time and time again. We have a little bit of sideways movement in the middle, and then we have that same type of panic and panic time and time again, showing you that weakness which is occurring in the marketplace. Another great stock that we can look at is Walmart. We can see that Walmart stock towards the end of last year, I'm trying to remember the news that came out which tried to justify it, and for whichever reason now, I just can't seem to remember it. I believe, I'm half guessing here, I know that they had to increase the hourly rate which they were paying their workers, and I think it might have been the first results which were announced post. Yes, a couple of people agreeing with me, Eric and Chirendra, many thanks. I think it was the first financial announcement that they had made after they had increased their pay, and for obvious reasons it wasn't as good as what they had forecasted to be, and you can see that massive engulfing pattern which then took place. Okay, so that's a good introduction into these different types of Japanese candlesticks. A good introduction as to why we find them to be so useful and how they provide us with opportunity. You see, Japanese candlesticks, they simply shed light on the marketplace. They're interpretive, they're not crystal balls. If you're totally new to trading, this evening might have been a little bit confusing. The last thing we want is for any educational event to be in any way confusing. But the truth is that this is your opportunity to go out and to truly learn this subject matter. Watching the lesson again, asking your support team a question, that will genuinely help you to understand this subject. A lot of you are looking to achieve quite a lot from your trading. You've got to put in something as well. You don't just get great results for nothing. Now, what we're going to do before we finish up, and I do have a good announcement to make about making the PowerPoints available to you after the fact, so just hang on for one moment for anybody who's rushing off bang on the hour. But I will, as tradition dictates, by this stage, I want to show you a chart. And I want to, I suppose, help you to understand why technical analysis is important to us. This is a current FTSE 100 chart. It's the UK index. It's the London Stock Exchange index, the top 100 companies based in the UK. And I want you to tell me, based upon what you see to your, we'll say, still untrained eye, and I hope you don't find it in any way insulting for me to say that, but if you can tell me what you think the market is going to do based upon what you see. And while you are typing in whether you think it's going to rise, whether you think it's going to fall, if you think you're going to buy or you think you're going to sell, if you think it's going to go long, if you think you're going to go short, type in what you feel is due to happen, and let's have a look at a couple of things. A couple of things which we have touched on this evening, which we're going to continue with over the next couple of technical analysis classes. The first thing that I've circled is we have an inverted hammer. This inverted hammer is potentially hammering out a bottom. So we have that. We could say that that is one piece of confirmation. So we have that, and then we have these areas of interest, I suppose is what I'll call them. We have point number 1, where the market came down, hit this precise level and bounced away from it. We have point number 2, which is the second time the market came down, found an area and bounced away from it. And then we have the potential that this might be point number 3, where the market is coming down and we have a question mark as to what might happen. But can we all see how this area 1, area 2, area 3, that they are not random pieces, they're not random prices? Can we all understand, or can we all see, and can we all maybe question as to why they react so precisely with a perfectly drawn straight line between A and B? What makes the price come down and bounce so precisely off such a straight line? Can we all see that? And can we all maybe now understand that we have one piece of confirmation, which is our inverted hammer, telling us that the market is potentially hammering out a bottom, and we now maybe have a second piece of confirmation where the market is potentially bouncing along this exact same straight line as it has done in the past. This might be an area of interest. Would you feel that there is a higher or a lower possibility that it will bounce off this line from a third time? It's bounced off it once, twice before. Do you think there is a higher probability that it will bounce off it again? You couple that with your inverted hammer, and you could say that there is yet again a higher probability. So this is why we like technical analysis. You don't hear me asking questions about whether or not George Osborne has come out with some statement, or whether or not Mark Carney has come out with some statement, or as to whether or not we even know who these people are, or what is happening with the UK economy that might make it rise or might make it fall. We don't ask ourselves any kind of questions like that. We just look at things from a technical perspective, look at what has happened to the price in the past, and to use that previous emotion experienced by traders in order to justify whether or not we should place an order to enter. So that is what we're going to be looking at, not only in 2 days' time, but over the next, I'm going to say again, 3 to 4 classes at least. A lot of technical analysis we want to look at yet. So in summary, what we're doing is we're targeting retail traders. We're going to be using our own counter retail trading techniques. We want to help to anticipate, not predict. We want to try to anticipate the order flow, because it is only the orders which moves the markets. You've got to separate yourself from those who lose. You've got to separate yourself from the normal retail trader. So it is understanding this activity of the normal retail trader which is what is going to help us become successful. The next step, as always, is to attend all of the live classes. Only by attending the live classes will you get the opportunity to ask questions, and that's where you will see the most value. We will, of course, be giving away that lifetime prize to Show Academy during the 8th lesson. The next session in 2 days' time, we continue on with our charting techniques. It's called elementary charting. The biggest question which we've received up to now, we're on the 4th lesson, we're on the 3rd live lesson, which is the 4th lesson, but the biggest question that the support team have gotten, which I have been asked personally, is are the PowerPoints available? We've thought long and hard about how and why and what to do to make them available to you. So we have come up with, I guess, a little bit of a request of you guys in order for you to receive the PowerPoints. We don't want to charge you for them in any way, shape or form. That's not what we are about. You've already paid for the course. There is absolutely no reason why you should want to be charged for anything else, okay? So what we'd like you to do is to leave an honest review of our services on our Facebook page. So if you go into www.facebook.com/Show Academy, simply leave a review, be it good, be it bad, as long as it's an honest review. Leave a review as to what you have thought of the course up to now, what you think we're going to cover, how you think it has been before now, if there's something specific you want to have a look at, and we will give you the PowerPoints absolutely for free. Absolutely for free. No problems whatsoever. If you don't have a Facebook account, don't worry about it. I'll come up with something. I'll get my brain working somehow, and we'll come up with something, whether it's in the next class or even in the class after that again, and we'll come up with something to be able to help out everybody who does not have a Facebook account. So don't panic. We're going to make sure that everybody gets satisfied one way or the other, guys. Okay? Don't worry about that at all. So, hopefully, I hope the support team are now going to be typing in that address, so you're going to be able to go straight to it if you wish and leave that review. And what I'll do now is I'll take my traditional, I guess, 30 seconds or so of a break. I'll take a quick drink of water, and then I'll be right back to answer as many questions as I can. So type in anything that remains outstanding, guys, and I'll come back to do my best to go through it. Many, many thanks. Okay, guys, let's have a quick look. Let's have a look. What other tools or indicators will we be... What other tools or indicators will we be going through? I think that was it. Apologies, the screen kind of moved a bit quick on me. Let me see if I can get it back. Okay, Hassan, you're saying, what other tools or indicators will be used to trade successfully? Yeah, we'll be going through, I suppose, quite a lot of them, Hassan, to be honest with you. Maybe a little bit too many to go through right now, but everything from moving averages to Fibonacci's to oscillators, to different kinds of support and resistance. Certainly the most common, and certainly all that you would need in order to be able to make a good decision. Let's not try to complicate things. A good decision as to what retail traders are doing, so that you can then take advantage of them. What else have we got? A lot of people asking for the answer to the question on the FTSE. I guess that's why I put it up there. Like I've said up to now, as far as those charts are concerned, as far as those polls are concerned, I don't really want to answer the question as to what we feel it's going to do or anything of that nature, simply because we're going to be going through them in detail throughout the next couple of classes. I prefer for you to use it for what it is intended for, to make a decision, if you like, without still really knowing what you're doing, okay? And then to see if we can help you justify that decision as we progress a little bit further. Maria, are you asking where would you normally see these charts? We'll be helping you with that during lesson number 7, which I think is tomorrow week. I'm fairly sure it's tomorrow week, Maria. We'll be helping you go through that. We'll be helping you get access to these types of charts, and then you'll be able to practice in your own time. Diana, that question might also be pertinent to you. We'll be helping you gain access to these types of charts in a completely risk-free environment, a practice trading environment, which again is of absolutely no cost to you. I believe it's tomorrow week. What else have we got? Let me have a look. Yeah, Nicole, if you want to review the recordings at any stage, you just go into the members login and academyoftea.com, go into the members login, put in your email address, which is your username, put in your password, which you would have chosen yourself, and then you'll be good to go from there. Many thanks, Laura. Many thanks indeed. Order flow, Edmund. Yeah, I suppose it's just the quantity of orders, if you like. If there is a larger number of buy orders than sell orders, then the market is naturally going to go up. If there's a larger number of sell orders than buy orders, then the market is naturally going to fall down. So it's the flow of this, the flow from the number of buys to the number of sells and vice versa, which is the order flow, which dictates the direction in which the market is going. Many thanks, Steve. I appreciate it. Thank you very much. What else have we got? Let me have a look. Yeah, for those people who are saying that they don't have a Facebook account, don't worry at all. We'll come up with some way, shape or form for you to get access to the PowerPoints as well. No problem whatsoever. We'll be able to help you out. No trouble. Adrian, you're asking if there's an indicator showing buying and selling volume. Yeah, there is a volume indicator, Adrian, although I'll put in a little bit of a caveat. Too often it's not very good, simply because it tends to show the volume from that specific broker and not the actual market volume. What we're interested in is the market volume, okay? And you tend to only get that from the exchanges. But again, we'll be helping you out in order to be able to trade successfully from that counter retail trading perspective. What else have we got? Yeah, Deborah, no trouble whatsoever. If you want to leave a review and then just let us know, pop us through an email and let us know that you have left a review, and we'll be happy to provide you with the PowerPoints. Of course, that's no trouble whatsoever. V-Day, you're asking about the candlestick charts. What's the best duration time frame? We always use a daily candlestick chart. A daily candlestick chart. What else have we got? Frank, many thanks. Yeah, guys, for everybody who is leaving reviews, and there's quite a few of you already typing in, so that you have left them, massively appreciated. It will take, just please allow us about 24 hours to, what we have to do, obviously I have to convert tonight's presentation into PDF, and then we'll be able to email it out to you. So it'll probably be the next 24 hours or so where you get the first 3 classes at least in PowerPoints, okay? So if you don't mind just giving us that little bit of wiggle room in order to convert. I know it doesn't take long to convert from PowerPoint into PDF, but just so I'll be able to provide the support team with all these slides, and then we'll be able to give them on, pass them on. What else have we got? Adam, you're asking if there's any other reason to look at other charts, as in an hourly chart or a minute chart, if you're working with the daily charts. Yeah, some people like to look at other time frames, Adam, just maybe to justify or to confirm, if you like, that a move does indeed exist. But we tend to always use the daily candlestick chart by default. What else have we got? Michelle, you're asking about the Facebook page. Yeah, sure. It's www.showacademy.com. Excuse me, it's not. Excuse me. It's www.facebook.com, of course, /Show Academy. But I hope the support guys have been typing it into the chat box, so you should find the link in there if necessary. Yes, they have indeed. So if you open the chat box within the software itself on the left hand side, you should see the link within there. What else have we got? Yeah, Andy, we'll be going through the operation and the functionality of an MT4 platform. We will indeed. That is tomorrow week that we'll be doing it. Nikolai, you're asking for a good suggestion or a good book on market psychology. Yeah, look, one of the better ones out there, I think, to be honest with you, in every instance, regardless as to whether or not it's dedicated just to psychology. It's not, but it just does give you a good overview of the markets and how they work. It's a book called Reminiscences of a Stock Operator. That's Reminiscences of a Stock Operator, and it's written by I think it's a ghostwriter by the name of Edwin Lefebvre, but it's written about a guy called Jesse Livermore. But if you go to Google and type in Reminiscences of a Stock Operator, I'll say it again because people will always be typing in, what's the name of that book again? It's Reminiscences of a Stock Operator. The good news is that it's actually out of copyright, believe it or not, because it's that old. It was way back, I think, in the early 1930s it was written, but it's a fantastic book, one that should be written by anybody who's considering trading. It's out of copyright, so you'll be able to just go onto Google, type in Reminiscences of a Stock Operator, and you'll be able to access it absolutely for free, because it is out of copyright. You're doing nothing wrong. Don't worry at all about it. What else have we got? Let me have a look. Mohit, you're asking if we can give an idea as to what a stock might do, like Microsoft or something like that. Yeah, absolutely. We'll be going through a lot of individual stocks, or in particular over the next two classes, Mohit. So hopefully that'll be able to help you out. Enrique, you're saying that book, Reminiscences of a Stock Operator, it's also available on audiobook, believe it or not. So there you go. Catering for all. What else have we got? I think that might be about it, guys. A good resource to find some sample charts to study. Shazand will be helping you with that. No problem at all. We'll be helping you with that throughout this course. Walton, you're asking how far back should you search in a candlestick chart. I tend to go back about 18 months. You know, the default setting on my chart is around about 6 months thereabouts, Walton. But you know, if I'm looking at it, I'll just zoom out a little bit, see what's been happening over the last 18 months thereabouts, and then zoom back in, just to get an idea as to what the market is indeed doing. What else have we got? Ariel, you're asking if there are no retail traders. Do you agree that this candlestick algorithm is not true? Not at all, Ariel. I would not agree with that at all. I don't believe there will ever be an instance where there will be no retail traders. The market simply wouldn't exist if there was nobody trading it. What else have we got? Syed, you're asking if there's a difference between stocks and commodity candles. Absolutely not, Syed. If you imagine, it's always the exact same. It's the same type of indecision. It's the same type of exhaustion. It's the same type of directional change. It's the same type of annihilation, if you like, that is experienced regardless of the market. Whether it's a currency market that you're looking at, whether it's a commodity market that you're looking at, whether it's an actual stock market that you're looking at, all is the same. And yes, Thomas, great question. You're asking if points and pips are the same. Yeah, you can consider them to be the exact same, Thomas. Points, pips, ticks, they're all the same. They're all the same. They're all incremental moves of the market, all the lowest incremental move of the market. What have we got? Viad, you're asking if we should consider inflation in candlestick charts. No, not at all, Viad. Not that you shouldn't consider it, but if inflation was to occur, you'd see it in the form of currency devaluations, or you could see it in the form of commodity increases, things like that. So that's the only way, or that's all you'd have to. I won't even say worry about, because it would provide quite a useful trading opportunity. But that's how you would see it on the chart. Let me have a look. I think that's about it, guys. Mark, excuse me, you're asking how long I've been trading. It's probably over 10 years at this stage, Mark, to be honest with you. How long it took me to get up to speed? Gosh. How long did it take me to get up to speed? That's a great question. I would say a couple of months, Mark, to be honest with you. I don't know if it was too long, because I always had an interest, even if it might have only been a passing interest in the markets and how they worked. And, I was always tending to, flick onto whether it was, Bloomberg or CNBC or something businessy related, or stock markety related, or financial markets related, in order to see what was going on. I genuinely, I actually can't remember how long it took me to get up to speed, but a couple of months, absolutely fine, nothing wrong with it. What else have we got? Let me have a look. Frank, you're asking what my net worth is. It's probably close to zero, Frank. My wife has it all. What else have we got? I think that might be about it. Vishal, you're asking if I trade multiple charts or to stick to one. I trade multiple markets, Vishal, absolutely. If I was to just trade one market, it's a bit like, having all your eggs in one basket. It's good to be diverse. Diversification is an important point of risk management, and it's one that we'll be looking at quite a lot, in particular during that risk management class, which is lesson number 9, which is still, it's still 2 weeks away, isn't it? It's not next week. Is it week? No, it's not next week nor the week after. It's the week after that again. What else have we got? Gladys, I do apologize, but I know that I know that you know that it was meant in the spirit it was intended, I guess. Okay, what else have we got? Okay, I think that's about it, guys. Look, I'm massively looking forward to coming back to continue on with these charting techniques in 2 days' time for lesson number 5. Believe it or not, in 2 days' time, we're going to be at the halfway point. But I'm really looking forward to you guys all coming back. We'll have more conversations, we'll have a bit more of a laugh, hopefully. We'll have more questions, and we'll make more progress, which is what it's all about. So in the meantime, I hope you're having a good start to the week. I'll be back to speak to you all very, very soon. Take care for now. All the best. Bye-bye.
Now, I'm not saying I don't like kids. I like kids. I have fun hanging out with my friends' kids and joking around with them, whatever. They're great. But I do feel like when I talk to my friends that recently had kids, it does seem like they had to give up everything for the kid. And that's very scary. You want to have a depressing conversation? Talk to a couple that just had a kid. Ask them about the last night they went out for themselves. They will describe the most boring, typical, mundane evening out.